The gold surge isn't a cute risk-off trade anymore. It is starting to behave like a referendum on the entire credibility stack. And there are powerful incentives to keep you thinking this is just another emotional spike that'll fade when the headlines cool off. Because once you see what's actually driving the bid, you can't unsee it. And the payoff for you by the end of this is simple and concrete. What levels matter right now, what the market is quietly signaling through spreads and positioning, what the next week or two is likely to look like, and the one line in the sand that would tell you this whole thesis is breaking. Here's the cleanest way to frame what's happening without getting hypnotized by the noise. Gold has been pushing into fresh highs and holding them with a kind of stubbornness that doesn't match the temporary scare story. You don't get that kind of persistent pressure just because people are nervous for a day. You get it when the marginal buyer isn't a tourist. You get it when the buyer is structural, when it's reserves, collateral policy hedges, and real money allocation decisions that don't unwind on a random Tuesday. And that's where the real pressure starts. Now, I'm going to say something that will sound almost too simple, but it's the cornerstone of this whole setup. In gold, the loud price is not always the true price. Gold is one of those markets where you're dealing with two realities at the same time. The paper reality, where claims trade instantly in massive size with leverage across futures and OTC derivatives, and the physical reality, where metal has to be sourced, refined, transported, allocated, delivered, and sometimes it has to show up on a specific schedule. When those two realities are aligned, the market feels normal. When they start pulling apart, you get the kind of moves that make everyone argue about conspiracies. But you don't need conspiracies. You just need incentives, constraints, and plumbing. And right now, the plumbing is the story everyone keeps trying to summarize into a headline that sounds harmless. Geopolitics, rate expectations, tariff risk. Those things can matter, sure, but those narratives are comfortable because they let institutions pretend this is just another trade you can fade, like a storm cloud that passes. What they don't want to say out loud is that gold is acting like a balance sheet instrument, like a collateral asset, like a reserve hedge, like an insurance policy against policy itself. And once the market starts treating it that way, the entire character of the move changes. But that's not the part that matters yet. The part that matters is what's hiding in plain sight. The United States, the core issuer at the center of the dollar system, still carries its gold on official books at a statutory price from another era. Not mark to market, not fair value, a statutory number. And whether you think that's quaint or irrelevant, understand this. Changing that number is not just an accounting tweak. It's a political choice that interacts with the most sensitive parts of the system: debt optics, central bank balance sheets, fiscal constraints, and confidence. The market doesn't need the policy to happen tomorrow to start pricing the option value of the conversation. Because if this one lever is even plausible, it forces a rethink in how people hedge the next regime. And the next detail is what flips the whole setup. Let's get specific, but keep it grounded. The Treasury owns the gold. The central bank doesn't have a pile of bars. It can just reprice like a trading desk. The way the system is structured, there are gold certificates and accounting mechanisms linking Treasury and the central bank balance sheet. When people talk about Fed gold revaluation, the real substance is usually Treasury side valuation and the way that would flow through the broader balance sheet plumbing and fiscal narrative. It's not a magical trick that prints metal. It's a potential one-time valuation change that could reshape constraints. And markets live to front-run constraint changes. Now, before anyone gets too excited, hear me clearly. A revaluation is not guaranteed, not imminent by default, and it's politically radioactive. But it's also not science fiction. Variations of reserve revaluation have been discussed historically in multiple contexts, often when sovereigns want flexibility without admitting they re-cornered. Even if nothing happens, the mere fact that serious market participants can model what it would do is enough to change positioning. Because markets don't wait for certainty. Markets price probabilities. And probabilities change when stress rises. Because if this one level breaks, the math changes. So what should you be watching if you want to separate a real structural bid from a headline pop? You watch the things that don't do theater. Start with the term structure. Futures curves, spreads, and the cost of carrying exposure. In a normal contango world, longer dated contracts can price above spot because you're paying financing, storage, insurance, and the opportunity cost of money. But gold is also a monetary metal. Its carry is deeply tied to rates, funding conditions, and the willingness of balance sheets to intermediate. When the curve flattens in ways that don't match the simple story, or when you see stress pockets around delivery windows, that's the market telling you something about immediate demand, financing, or constraint. Not in a conspiratorial way, in a mechanical way. Then you look at how the market behaves around delivery cycles and liquidity windows. Gold does in But a T-trade like a sleepy commodity when liquidity thins and hedging flows hit at the same time. You get air pockets. You get snap moves. You get those ugly wicks that shake out weak hands and then price snaps right back because the underlying bid hasn't gone anywhere. That's why the calendar matters so much right now. Month end, quarter end dynamics, option expiry windows, delivery periods, even policy meeting timing. These are the moments where the market is forced to reveal who's in control. The calendar is the catalyst. And here's the dirty secret of modern markets. The fastest moves often come from hedging, not from opinions. Most people think big rallies are people getting bullish, sometimes. But the most violent phases are when risk managers and dealers are forced to buy because the math tells them to. That's gamma. That's delta hedging. That's the reflexive loop where the market's structure becomes the engine. Let me explain this cleanly without drowning you in jargon. Options have sensitivity to price. When price rises and a lot of call options are outstanding at certain strike levels, the dealers who sold those calls often hedge by buying some of the underlying exposure. As price rises, that hedge requirement can rise too. In certain conditions, especially when the market is near key strikes, dealers can become forced buyers. Not because they love gold, because their risk model demands it. That buying pushes price higher, which increases hedge needs, which pushes price higher. That's a gamma-driven move. It can turn a controlled grind into a squeeze. It can also reverse violently when price falls away from those strikes and hedges unwind. That's why you can be right about the trend and still get emotionally destroyed by the path. And the market knows that. The market uses it. So when you see gold surge and people say it's just fear, what they were really doing is giving you a story that sounds human, so you ignore the mechanical forces that are much harder to fade. Because a mechanical force doesn't care about your narrative. It doesn't care if you think the rally is overdone. It cares about hedges, margins, collateral, and constraints. But that's not the only layer here. Let's build the proof stack, because one argument is never enough in markets. You want 5, you want 6, you want redundancy. First layer, the macro regime. If the market is transitioning into a world where policy credibility is questioned, or where fiscal dominance whispers louder, gold's role changes. Gold thrives when real yields are unstable, when currency confidence is a trade, when reserves diversify, when geopolitics introduces settlement risk, and when the risk-free asset stops feeling risk-free. Even if nominal rates are high, if the path of rates and the path of inflation expectations feel unanchored, gold can still catch a bid as a hedge against regime uncertainty. And that's where the real pressure starts. Second layer, institutional flows. ETFs and ETPs can act like a barometer for retail and wealth channel demand, while the bigger silent actor is official sector behavior. Central banks have, in recent years, acted like gold is not just a commodity, but a neutral reserve asset, something that sits outside sanctions risk, outside counterparty risk, outside someone else's liability. That doesn't mean gold will go up forever. It means there's a floor-like behavior that can appear in drawdowns because the buyer is not a day trader. The buyer is an allocator. Third layer, physical market symptoms. You don't need to invent dramatic shortages to see stress. You look for premiums, for delivery delays, for tightness in certain products, for changes in refining and logistics flows, for divergence between regional pricing hubs. In gold, regional pulls matter. If demand intensifies in one region and the arbitrage pipeline is constrained by logistics, financing, or regulatory frictions, price can be pulled through global arbitrage. Gold is a global magnet system. When one side gets heavy, the whole needle turns. Fourth layer, inventory and deliverability categories. People love to scream about inventories falling as if it's a guaranteed price signal. It's not. But inventories are a stress thermometer. There are categories that are deliverable against contracts and categories that are not. There's registered versus eligible type distinctions in some venues. When deliverable inventories change in meaningful ways, it can signal shifts in willingness to make metal available at current prices. It can also reflect financing decisions. It can reflect reclassification. The point is not to worship the number. The point is to watch the behavior. What is being made available? What is being withdrawn? That's a clue about stress. But that's not the part that matters most. Fifth layer, spreads and financing signals. Gold has a unique relationship with funding markets, lease rates, forward points, the cost of sourcing metal for delivery, the willingness of banks to intermediate, and the balance sheet cost of carrying exposure. These are quiet signals that can matter more than a dramatic headline. When funding is easy, paper can dominate. When funding tightens or balance sheets retreat, physical constraints can show up faster, and the market can move in a way that feels mysterious if you are only watching spot. Now stack that with the hidden detail again, the official valuation. The statutory number is the kind of thing that sounds like trivia until stress rises and people start looking for levers. A revaluation in concept would create a valuation gain on official holdings. That gain could change how certain accounts look, how constraints feel, how confidence is managed. It could, depending on the policy path chosen, be framed as strengthening the balance sheet. Or it could be criticized as a backdoor monetization signal. Either way, it's not neutral. It's a message, and markets trade messages. Here is the conflict that S going to define the next phase. The system wants you to believe gold is just a trade, so that a rising gold price doesn't become a headline about confidence. Because when gold rips, it's not just investors getting excited. It's investors hedging against the issuer. It's the mirror held up to the currency regime. That's why it gets downplayed. That's why it gets mocked. That is why you coin will get endless commentary about how gold doesn't yield anything right at the moment when yield itself feels like a liability. Because if people start treating gold like a core reserve hedge again, that's a problem for a narrative that needs everything to look stable. But the next detail is what flips the whole setup. The next detail is the why now. Because even a correct thesis can be early, and early can feel identical to wrong. Right now, we're sitting in a window where liquidity and calendar effects can amplify moves. Month-end and quarter-end rebalancing is not a myth. When funds rebalance, when hedges roll, when options expire, when delivery notices become relevant, and when policy communications land, the market's microstructure becomes more important than your macro opinion. Thin liquidity can make small imbalances look like monsters. And if the market is already leaning one way, if shorts are crowded, if dealers are pinned near key strikes, if volatility is rising, then the calendar becomes a trigger, not just a date. So what happens next week or two? Think in two scenarios, always. Scenario 1, controlled pullback and retest. Gold can pull back sharply, scare everyone, test a prior breakout zone, and then stabilize. That kind of pullback is not bearish by default. In fact, it can be bullish if it flushes weak leverage and resets positioning. What you'd watch in that scenario is whether dips get bought quickly, whether the market holds a key support zone, and whether spreads remain firm rather than signaling a collapse in immediate demand. A controlled retest is the market building a floor. Scenario 2, continuation squeeze and gap risk. This is the scenario where gold doesn't give you a comfortable pullback. It consolidates briefly, then punches through resistance, and the move accelerates because hedging flows and short covering stack on top of real demand. In this scenario, the risk is not it fades. The risk is that it gaps, that it runs through levels faster than you can think, that your brain tries to chase, and then a volatility spike punishes you. This is where the market transfers wealth from impulsive buyers to disciplined operators, and that's where the real pressure starts. Let's talk levels, because levels are where psychology meets mechanics. If gold has recently been pressing into the mid to upper 4,000s, then the obvious magnets are the round numbers and the prior highs. Round numbers matter not because they're mystical, but because positioning clusters around them. Options strikes cluster. Stop losses cluster. Risk models reference them. A zone like $4,500 can act like a battlefield. A zone like $4,700 can act like a trigger. A psychological threshold like $5,000 can become a headline magnet that pulls price simply because the world can resist the narrative of a big, clean number. Here's how to use those levels without getting hypnotized. The support you care about is not a single dollar value. It's the region where the last breakout happened, where price previously struggled, and where it should find demand if the move is real. If gold breaks out, runs, and then comes back to retest that breakout zone, holding it is a confirmation of structural demand. Losing it decisively, on heavy volume, with spreads weakening, with a change in the character of buying, would be a warning that the move was more fragile than it looked. Because if this one level breaks, the math changes. Now, I'm not here to give you a fantasy map that says, buy here, sell there. That's not how grown-up risk management works. The goal is to give you a framework, identify the zones that define trend versus noise, define what would confirm the thesis, and define what would invalidate it. That's how you stay sane in a market that wants you emotional. So what confirms this thesis over the next couple weeks? You want to see gold hold above its recent breakout zone after volatility spikes. You want to see dips bought with urgency, not with hesitation. You want to see the term structure remain firm rather than screaming, no one wants immediate exposure. You want to see signs that the move is not just leveraged tourists, meaning volume patterns that show real participation, not just a single spike that fades. You want to see continued evidence that gold is being treated as a reserve hedge, central bank behavior, steady allocation, and resilience even when the daily headlines flip. What weakens it? A decisive breakback below the key breakout zone, followed by failed retests, where price tries to reclaim a level and gets rejected repeatedly. Spreads that deteriorate in a way that signals financing pressure is pushing people out. A collapse in the character of the bid, where rallies become thin and easily reversed. or a macro shift where real yields stabilize in a credible way and currency confidence is restored sharply. Any of those could cool the trade, and you need to be honest about that possibility, because markets punish certainty, but that's not the part that matters right now. The bigger question is why the revaluation concept is so sticky in the narrative, even when it sounds far-fetched to casual observers. The answer is that the system is under constraint, and when systems are under constraint, people look for levers. The US has massive debt issuance needs over time. The political fight over fiscal space never really ends. The central bank is balancing inflation credibility, growth risk, and financial stability. In that environment, ideas that expand perceived flexibility become attractive, even if they're controversial. A reserve revaluation is essentially the idea of changing the official price at which reserves are carried, which can create a one-time valuation gain. Think of it like this. If you have an asset carried at a book value far below current market value, you're sitting on unrealized value. Changing the book value doesn't create new metal, but it can change balance sheet optics. It can change how certain accounts look. It can be used in some theoretical discussions to improve perceived fiscal capacity or to restructure how certain liabilities are viewed. The details matter, the legality matters, the politics matter. But markets don't need the policy to be clean and easy. Markets just need the probability to be non-zero under stress. That's why gold can catch a bid when these conversations rise. Because gold becomes the hedge against policy improvisation, against the we'll figure it out later approach that tends to show up when constraints tighten. The irony is that the more people insist that would never happen, the more valuable the hedge becomes, because hedges are for what you don't expect. And that's where the real pressure starts. Now, let's talk about the other side of the trade, the forces that want to suppress the move, not in a movie villain way, but in a rational incentives way. If you run a system whose credibility depends on the perception of stability, a rising gold price is awkward. It's a visible measure of demand for an asset outside the system. It suggests hedging against the issuer. It can be framed as fear, so it doesn't become confidence erosion. And if you're a large institution with exposures tied to rates, currencies, and macro stability, you don't want clients asking, wait, why is gold screaming? Because that question leads to uncomfortable conversations. So what do? You narrate it away. You reduce it to one headline, you mock it, you call it a barbarous relic. You say it's a trade for people who don't understand yield. Meanwhile, the spread behavior keeps talking, and the positioning keeps shifting. The vault flows keep giving you small signals. The global arbitrage keeps pulling. The market structure keeps tightening. And that's where the real pressure starts. Let's do a quick pattern interrupt and make this visceral. Imagine you're a dealer who sold a stack of call options because clients wanted upside exposure. Price starts rising. Your hedging model tells you to buy. You buy. Price rises more. Your model tells you to buy more. Meanwhile, a macro fund that S short gold as A rates are up. Trade starts taking heat. Their risk manager sees the drawdown. Margin requirements rise as volatility rises. They're forced to cut. They buy to cover. Price rises more. Now you have a reflexive loop. Dealer hedging plus short covering plus real money demand. This is not a conspiracy. It's a machine. And machines don't care how you feel about the chart. That's why the move can look too fast and still be structurally sound. Because the speed is not purely opinion. It's forced behavior. But here's the catch. That same machine can reverse violently on a bad day. If price dips below a key strike cluster, dealer hedges can unwind. If volatility spikes and liquidity thins, a small push can cascade. That's how you get the gut punch red candles that make people swear off the trade right before the next leg up. And that's why you need the psychology shield. Here's the psychology shield you need tattooed on your decision making. Volatility is not just a byproduct, it's a weapon. The market uses volatility to transfer position from people who need certainty to people who can tolerate ambiguity. It does it with two emotions, FOMO and regret. It rips higher to make you chase, then it snaps down to make you feel stupid, then it recovers to make you chase again. If you don't have a plan, levels, invalidation, sizing, you become liquidity for someone else. And that's where the real pressure starts. So how do you avoid being emotionally manipulated? First, separate trend signal from noise. Trend signal is the market holding above key structural levels, maintaining constructive structure after pullbacks, and showing persistent demand. Noise is intraday spikes, headline whipsaws, and liquidity-driven wicks that don't change structure. Second, size, so you can survive the path. If your position size is so big that a normal drawdown makes you panic, you're not investing, you're gambling. Third, pre-commit to your invalidation. If you decide, below this zone, my thesis is wrong, then act like an adult and respect it. Don't negotiate with the chart in real time. Now, let's bring it back to the what to watch next checklist, because this is where you earn trust with logic, not hype. Watch the curve and spread behavior around key windows. Watch how price behaves around the big magnets. Watch for the character of the dips. Do they get bought fast or do they bleed? Watch for evidence of stress in physical channels, premiums, delivery chatter, tightness signals without exaggerating them. Watch for macro cross signals, the dollar's behavior, real yield stability, risk sentiment shocks. Watch for institutional posture, whether the tone shifts from cute trade to core hedge. And watch the calendar, because the calendar is when the market is forced to reveal who's trapped. Let's talk about traps, because that's the part most people miss. In a gold move like this, the trap is not just retail shorts. The trap can be a worldview. The trap can be an entire class of macro positioning that assumes the old regime still holds. Rates up means gold down. That relationship can hold for stretches and then break when the market starts hedging policy credibility instead of just rate direction. If you're short gold because you're short inflation or along the dollar, and the market decides the real hedge is against the issuer itself, you're not just fighting price, you're fighting a regime shift. And that's where the real pressure starts. Now, can the counterpoint win? Of course. If policy credibility strengthens, if inflation expectations anchor, if growth stabilizes, if real yields become predictably high without breaking something, gold can cool off. If revaluation conversation dies quietly, the option value can shrink. If positioning gets too stretched, gold can pull back hard just on mean reversion. That's why you don't marry the trade. You date it with boundaries. But here's the thing. Even a pullback doesn't kill the bigger story if the underlying reasons remain. If gold is being treated as reserve insurance, then pullbacks become reallocation windows, not just top signals. And that's why you keep your eyes on structure, not emotion. So where are we right now in practical terms? We're in a zone where gold has shown it can break higher and attract follow-through. That's bullish. But it's also a zone where the market loves to manufacture volatility because attention is high. That means you should expect whip. You should expect aggressive fake-outs. You should expect days that make you question your sanity. And your job is to not let those days force you into a bad decision. If you want a simple roadmap, use this two-scenario lens. If gold pulls back and retests the breakout zone, call it the recent support region, watch whether it holds and whether buying returns with volume. That's scenario one. If it holds, you're looking at a market building a base for the next push. If it fails and can't reclaim, that's a warning. If gold doesn't give you the pullback and instead grinds sideways, then pops through resistance, call it the recent highs and the big round number magnet, watch for acceleration signs, fast moves, rising volatility, and the sense that liquidity is thinning. That's scenario two. In that world, the risk is chasing too late. The smarter move is to know your levels ahead of time and not get hypnotized by the candle. And now let me give you the one metric mindset without pretending they're a single magic number. The metric you care about is the market's willingness to pay for immediacy. That shows up in the curve, in spreads, in the behavior around delivery windows, and in the resilience of price after shocks. If the market keeps paying up for immediate exposure, or keeps refusing to let price stay down when it S offered, then the bid is real. If the market starts offering metal exposure cheaply over time and spot weakens structurally, then the move is losing its engine. Because if this one level breaks, the math changes. And now the final piece. What does all this mean for you? The retail investor who's skeptical of institutions and allergic to narrative fluff? It means you should stop watching gold like it was just another chart and start watching it like it's a stress signal. A signal about reserve behavior, about policy credibility, about the value of collateral, about the global arbitrage that connects financial centers and real demand. Gold is not just a trade, it's a mirror, and mirrors make people uncomfortable, which is why the loud voices will keep trying to tell you the mirror is lying. They'll call it fear, they'll call it superstition, they'll say it's irrational. Meanwhile, spreads don't have opinions, dealers don't have feelings, risk managers don't care about your narrative. They care about exposure and survival. So here's your clean, near-term checklist, right now, this week, and into the next couple weeks. Identify your key zones, in the recent breakout support region, the recent high resistance region, and the psychological magnet above. Decide what would confirm. Holding support after pullbacks, resilient demand, constructive structure, and stable to firm curve behavior. Decide what would invalidate. A decisive breakdown below the support region with failed retests, a clear deterioration in structure, and a shift in the character of buying. Keep the two-scenario lens, controlled retest versus continuation squeeze, and know which tells you're watching for each. And above all, keep your psychology shield up. Volatility is the market's way of negotiating with your emotions. Don't negotiate back. And if you're still here, you're exactly the kind of person this market is trying to shake out. Not because you read wrong, but because you're paying attention to the plumbing. That's the edge. That's the identity. Not chasing candles, not worshiping headlines, tracking mechanisms, watching what participants are forced to do. Because when gold starts acting like a balance sheet instrument, the next move isn't going to be explained politely, and it won't wait for everyone to agree. Stay sharp, keep your risk clean, watch the calendar, and remember, the loud story is rarely the true story when spreads are screaming and positioning is cornered.